In October 2021, my stock portfolio crossed $1 million. Not my net worth, not including my real estate, just stocks, which includes my 401k, Roth IRA, brokerage account, and a few individual stocks. And today, I want to take you on that journey with me. I'll show you how my portfolio grew every 3 years alongside my salary. If you're new here, I'm Sushant. I retired at 41 with just my salary and smart investing. So, let's rewind. It's 2009. I'm just 14 months into my pharma career, making around $80,000 a year, and my wife is a respiratory therapist. The world is still reeling from the 2008 financial crisis. Banks failed, housing prices collapsed, and the S&P 500 lost almost 50% of its value in just 18 months. Like many people, I thought I was smart. Swine flu was in the headlines, so I put a chunk of money into small pharma companies. And I was so convinced that I would ride that wave. Guess what? It tanked. That was my wake-up call. I realized something very important. The US stock market has always crashed. The dot-com bubble, the 1987 crash, the 1970 oil shock, even the Great Depression. But every single time, it has come back stronger. So instead of trying to outsmart the market, I decided to play the long-term game. Back then, my portfolio was maybe $25,000. Just a start, but it was the foundation. But would that foundation hold or crumble like it had in 2009. By 2012, the market had bounced back nearly 35% from its lows. My salary had grown to $110,000, and so had my family. That year, Abhiraj was born. I was contributing around 10 to 15% of my income to investments, and my portfolio grew to $80,000 to $90,000. And honestly, it didn't feel like much, especially when my friends were upgrading cars, buying bigger houses, and showing off their new toys. Meanwhile, here I was, quietly doing my dollar cost averaging into my brokerage account and contributing to my 401ks and Roth IRAs. And I'll be honest with you, I got tempted by shortcuts. I dipped into options trading, and yeah, it made me feel smarter. The adrenaline hit was real. The dopamine rush every time the trade went my way was addicting, but so were the sleepless nights. I would lie there asking myself, is this really worth it? The stress, the constant checking, the risk, and the answer was absolutely not. That's when I made two promises to myself. I will never sell just to book profits, and I will never try to time the market. Instead, I would automate all my investments and let time do the work. And through all of this, my wife was the quiet strength behind me. She worked full-time while studying full-time, paid her tuition in cash, and graduated with zero student loan. I had already knocked out mine in 18 months or so. So together we built our foundation. No debt, no leaks, and steady investing. But 3 years later, would that boring discipline finally pay off? By 2015, my salary had climbed to about $125,000 per year. And by now, I was serious. I was investing 25 to 30% of my salary like a clockwork. Every raise, every bonus, I didn't see it as any extra spending money. It went straight into the investments. And my portfolio had grown to around $250,000. And for the first time, I could actually feel compounding working. It wasn't just my contributions anymore. The market itself was adding to my wealth faster than I could. That's when I discovered something that completely changed the way I look at money. The rule of 72. I like to call it the rule of when will my money double all by itself. And here's how it works. It's simple math. Take 72 divided by your annual rate of return, and that's how many years it will take for your money to double all by itself. So at 10% return, my money would double in 7 years, and at 18%, doubles every 4 years. Simple, right? That meant my 250,000 could become 500,000 by 2022, even if I never add another dime. That's when it clicked for me. This is the eighth wonder of the world, and this is the magic of compounding. And it became the concept I built my entire financial life around. But little did I know, the real boost was about to come, and it wouldn't come from the market at all. Back in 2010, we bought our very first house. It was a foreclosed property listed at $99,000, but the real worth was around $170,000. Guess who got that deal? Of course, my wife. She's the hardest negotiator I know, the kind of person who can squeeze value out of anything. Fast forward 7 years, in 2017, we sold that house for $200,000. 50% of that money went straight into our new home, and the other 50% went straight into my portfolio. By the end of 2017, my portfolio was sitting at nearly $400,000. But here's the biggest shift that year. I finally got serious about asset allocation planning. I started asking myself how much money should go into US stocks versus bonds versus was international. How much money should I set aside for kids' education, for retirement, even for travel? And the most important question, what is my early retirement number? You don't just invest to have more money. You invest with clear target and a plan to reach it. That's financial planning. And I had my plan ready by that time. But here is the thing. Plans are only good until they are tested. And by 2018, the market would put mine to test in a big way. The headlines were everywhere. Red charts, panicked anchors, people whispering about another 2008. And I saw what most people did. They panicked, they sold, they wanted out before things got worse. By 2018, my salary had climbed to around $150,000. My portfolio had crossed $500,000. But as you know, the stock market doesn't move in a straight line. That December, the S&P 500 dropped almost 9%. It's the worst December since the Great Depression. But here's what I told myself. The market has always crashed, but it has never stayed down. So instead of selling, I kept buying. And that decision to stay invested when fear was at its peak turned out to be one of the most important choices I ever made. Well, then came 2020. COVID shut down the world. Offices closed, travel stopped, fear gripping everyone, and the market, it plummeted. In just 33 days from February 19th to March 23rd, the S&P fell about 34%, the fastest bear market in the history. I logged into my account and saw six figures gone, slashed on paper. That's the moment panic strikes. And I won't lie, the thought crossed my mind too. But by then, we were debt free. Our house was paid off, we had cash, we had a plan, and more than anything, we had discipline. So instead of selling, we stayed the course. In fact, I even made one surprising move. I bought MicroStrategy, one of the first companies to put Bitcoin on its balance sheet. And another move that wasn't surprising at all, our second son, Swaraj, was born. Honestly, for a risk-averse, ETF-loving guy like me, that MicroStrategy play was my way of dipping my toe into the crypto without going all in. And both of those investments, one financial and one personal, worked out better than I could ever have imagined. So where did that leave me by 2021? By 2021, my salary was close to $175,000. The markets had come roaring back from the COVID crash, hitting all-time highs. And that October, I did something I will never forget. I logged into my account. Here's what popped up on the screen. 401k, around $58,000. International stocks, around $80,000. Mostly it was an exposure to Asian market and Indian markets through US mutual funds and ETFs. Brokerage account, which includes my mutual funds and ETFs, it was around $517,000. Roth IRA, $230,000, and individual stocks, around $116,000. So altogether, it was just over $1 million in just a stock portfolio. So from $50,000 in 2009 to $1 million in 2021. I just sat there staring at the number. 13 years of discipline, of staying the course through crashes, of ignoring the noise, all staring back at me in one 7-figure snapshot. And let me add this just so you have the full picture. My wife has always been more into the real estate side. That's her world. We actually own a paid off rental worth about $450,000, and this house is already paid off. But this story, this milestone, it's just about our stock portfolio. That was the moment I knew boring consistency works. Looking back, 4 things got me to $1 million. Number 1 was consistency. I invested 25 to 30% of my salary every single year. Number 2 was debt-free living. My wife and I stayed frugal, avoided all the lifestyle creeps, and paid off everything. Number 3 was patience. I didn't chase hot stocks after 2009. I stuck with the ETFs, mutual funds, and the long game. Number 4 was the partnership. My wife's discipline was the silent force behind it all. It wasn't luck, it wasn't timing, it was just discipline and compounding. So if you're watching this and thinking I'm behind, here is what I want you to remember. In 2009, I was just a guy losing money chasing hot pharma stocks. And in 2021, I was the guy with $1 million stock portfolio. You don't need brilliance. You don't need perfect timing. You just need to start. Stay consistent and let compounding do the heavy lifting. If you're serious about building your own path to financial freedom, don't just stop here and subscribe to Money with Swabi and check out this interesting video I shared last week. Your finance friend Sushant, signing off.